Who are you getting your information from? Be conscious of where the information is coming from. If you were to Google first position HELOC, 9 times out of 10, the majority of the information you're going to receive as it relates to a first position HELOC is coming from a bank. What is the benefit of the bank offering you a first position HELOC? Banks and lenders, there's really no, I'll call it, incentive for a bank to offer you a first position HELOC. Why? Money. 9 times out of 10, it's a mortgage. All right, so real quick, just to highlight why we would even be talking about a home equity line of credit. It's really simple. A home equity line of credit is part of the piece to our puzzle as to how we were able to get to where we were or where we are. Meaning, we leverage our first position home equity line of credit as a vehicle, as a debt tool to be able to pay down debt and also feed our machine as far as generating income. So the main objective was, uh, hey, let's kind of talk through or kind of share with others how we got to where we are and what kind of tools we use. There are many ways to 10. We talk about many different vehicles, many different opportunities, many different actions you can take to be able to be successful. Using a HELOC to be able to accomplish a goal is just one of them. Fits for some, may not fit for others, but we just wanted to kind of talk through what that looks like. And we talked through this visual a lot as well. The thought process here is this: we are prone to take our income and do everything we can to make sure we save our home. And in addition, we'll even pillage our retirement to make sure we save our home. But the thought process is, what if you were able to leverage your home to actually help generate income for you that you could leverage, use for the rest of your life? So how do you leverage your home? What position does your home have to be in order for you to be able to leverage it, to be able to do the things that you want to do with the equity that you have? And again, as it relates to um, on Sunday, we kind of talked through this visual or this concept of, hey, when we compare a mortgage to a first lien HELOC, what does that look like? Meaning, how does a 5.2% mortgage rate compare to a 7.5% HELOC, and which one is better? And the moral of the story here is, what we learned was, you know what? With a home equity line of credit, you have full access to this equity, or actually full access to the value of your home through equity, through the ability of a debit card. It's liquid. And so what we learned was, yeah, maybe it's a higher interest rate. And if the goal was to play that interest rate over time, play that interest rate out over time, mathematically, like on the surface, a 7.5 interest rate would be worse. But when you focus on the goal, and that goal being able to leverage your equity now to be able to generate wealth, you actually end up spending less over time compared to a mortgage. And specifically, though, when we look at the differences between a mortgage and a HELOC, there are some pieces that I just wanted to make sure we highlight as well. Move that over a little bit. Just wanted to make sure we highlight some of the differences between a mortgage and a first lien HELOC as well. And so, what are some of those things associated with having a mortgage and a first line of credit that makes sense or does not make sense? Well, as it relates to payments, with a mortgage, your payments are fixed. With a home equity line of credit, the payment is actually variable. In most cases, it's an interest only payment, is what is required, but you are able to contribute whatever you would like. So there's no limitations on what you can contribute into that HELOC in most cases. In most first position home equity line of credit positions. And the rate for a mortgage is fixed, meaning it's the same for the life of the loan. For a first lien HELOC, it's variable, meaning it does have the ability to go up. And most of the times people think, hey, I don't want a first lien HELOC because of that variable interest rate, meaning it can always or only go up on me. But the oh, hold on. But the truth is that variable rate cannot just go up, it can also go down. Meaning, it can also get, depending on where interest rates are, this variable interest rate can also work in both directions, which is a positive as well. And then equity wise, equity inside of a first lien HELOC is liquid, meaning you have access to it to be able to do whatever you want. I talk all the time about, you meet me at Home Depot, you bring your equity, I'll bring mine, and how liquid, how accessible is that equity to you to be able to do and use it how you please. Versus in a mortgage, you have zero control. The only way you can access the equity inside of your mortgage is to refinance, start the clock over. Do a cash out refi and be able to pull some of that equity out. But that's a process. You have to be approved for it. You have to almost go back through the same process you went through in order to achieve your mortgage. Whereas With a line of credit, you do not. And then open-ended versus closed. When you put your mortgage payment into your mortgage, can you get it back? Can you access it at all? If you were to put an extra payment onto your mortgage, yeah, you would pay your mortgage off faster, but can you access any of those extra dollars that you placed inside that mortgage? Versus the first lien HELOC, it's open-ended, meaning not only can you put extra dollars into the home equity line of credit, right after you put that extra dollar amount onto the line of credit, you can actually pull it right back out. So, which hence kind of speaks to the cash flow. In most cases, a first position home equity line of credit has 100% accessibility to your cash flow versus inside of a mortgage, you cannot. And then the last piece, we talk some about recasting. Most people don't realize what's happening in a first position HELOC on a consistent basis, on a daily basis, is your first position HELOC is actually recasting every day, and it does it automatically. Meaning the cost or what you're contributing into your first position HELOC, the balance drops immediately, and then your home equity line of credit recasts to actually produce a new cost to you. Meaning that interest that's owed reduces or gets lower as the cash flow starts to build in your home equity line of credit, which means your home equity line of credit in first position recasts daily. Versus if you wanted to dump a lump sum onto your mortgage, the only way that mortgage payment would change is if you went through the process of recasting, which traditionally means there's a cost to it. Now, it's not an expensive cost. We talk about this a lot, meaning if you wanted to dump $10,000 onto your mortgage and recast it, 9 times out of 10, it's some type of administrative fee for them to recalculate everything. So it can be anywhere from, I've seen it from $150 to about 2,000 max as it relates to recast. But the moral of the story is inside of a first position home equity line of credit, it recasts daily. So the question that we wanted to answer today was this. The question we wanted to answer today was these two questions. Is a first position HELOC right for you? And who are those who should actually rethink whether or not they should or shouldn't get a first position HELOC? So again, is a first position line of credit something that you should be going after? Or you know what? Maybe you should kind of step back and rethink whether or not this is the path you should go down. Like who are those people? How do they fit? And the first question in order to answer that question, I want to highlight this. Who are you getting your information from? Be conscious of where the information is coming from. Meaning, if you were to Google first position HELOC or whether or not it's right for you or what are those steps you could take, 9 times out of 10, the majority of the information you're going to receive as it relates to a first position HELOC is coming from a bank. So look at it from the bank's perspective. If you wanted a first position HELOC, is a first position HELOC something that you should get? What do you think the bank is going to tell you? What is the benefit of the bank offering you a first position HELOC? And more importantly, as it relates to who is offering this first position HELOC to you, banks and lenders, there's really no, I'll call it, incentive for a bank to offer you a first position HELOC. Why? Because they don't make as much. So what is the bank's goal? Their goal is to sell products. What's their most, I'll call it, um, advantageous vehicle that they offer, meaning what vehicle do they offer that makes them the most money? 9 times out of 10, it's a mortgage. So why would they offer anything other than a mortgage as it relates to what you can invest in or invest with? And from a financial advisor's perspective, fee-based planners and those who are paid commission are the others who kind of talk through products like these or as to whether or not a line of credit is right for you. So be careful of my point is be careful of where you're getting your information from. So whether or not a vehicle like a first position HELOC is or isn't right for you, I would say spend a little bit more time doing your homework, understanding why you want a vehicle like this. What is the purpose? What is the goal? And what is it that most banks say as it relates to a first position HELOC or HELOC in general? Because in most cases, when you go to a bank for a HELOC, if you just walk in the door and say, "Hey, I want a HELOC," they are not thinking you wanting a first position HELOC. They are coming from the perspective of this must be a second position HELOC that you're asking for. And so, what do they want you or what are they expecting you to be able to use this HELOC for? Well, it's home improvements, repairs, paying for education and emergencies, consolidating high interest debt, and or starting a business. Nowhere in there does it say, hey, I want to leverage this HELOC. I want to be able to use this HELOC, leverage this HELOC to actually build wealth for me, to put this money to work. So when you're asking for a HELOC, be conscious of what it is you're asking for. And also know whether or not they approve you kind of depends on these items as well. Meaning the last thing you would want to do is walk into a bank and say, "Hey, I want a first position HELOC so that I can fund my cash value life insurance policy, so that I can fire my job at some point, so I can go after my WTF moment." That is the last thing you want to ask for a first position HELOC for. But so I'd say staying in this range of consolidating high interest debt is really more music to their ears, because the thought process is this: if you can eliminate debt, then that means that you're more likely to be able to pay off this mortgage, which means you're taking that first position mortgage, that mortgage that's in first position. You're more likely to be able to sustain the payments to the bank, which means they are more likely to get their money sooner. So, bottom line is, be careful of who you're talking to as it relates to when and why you want a vehicle like this. So, where during the market crash of 2008 or any of the downturns that we have seen over the years, where was most of the money made during the 2008 financial crisis? Meaning, when we were going through this, when we are going through 2008, where were most people making their money? Again, it was a downturn. Everyone was getting killed in the market. In most cases, people were making their money here. Well, what does this mean? What are we talking about? What we're talking about are non traditional investments. So, in most cases, during the downturn, most people were making their money, making their extra income or their growth in terms of putting their money to work by investing in non traditional investments. Well, how? How is it possible for you to be able to invest in these non traditional investments during a down market? Well, in order to do so, you have to have leverage. And so the question that I pose to you is, where is your leverage? Why shouldn't you be able to access your leverage? And meaning, the largest asset you have available to you is your home. But we have not been educated on how to leverage our home to be able to access this leverage. So why not you? If during the downturn, everyone who had access to leverage was able to put that leverage to work to be able to build and generate income, why not you?